purchase order. Purchase order is a document that asks a company to supply goods or services and that gives details such as the price to be paid and the method and date of payment. One is invoice. Invoice is a record of sale or shipment made by a vendor to a customer that typically lists the customer's name, item sold or shipped, sales price and terms of the sale. In other words, it's a statement of report detail of a sale for the buyer and seller's record. The next one is delivery order. Delivery order is a document which details the delivery information of an item, which is very important in distribution. A delivery is an important document in two ways. It has full details of how the delivery will take place. For the next one is payment voucher. Payment voucher is a document which can be used as a proof that a monetary transaction has occurred between two parties. In business, a payment voucher can be used for a variety of purposes, sometimes taking the place of cash in a transaction, acting as receipt or indicating that an invoice has been approved for payment.
This is example for purchase order, invoice, delivery order, and payment voucher.
Goods received notes. Goods received notes is a document produced when goods are received into the company or factory. It will usually accompany goods to any inspection and is used to check against invoice before the payment. The definition of goods received note in the dictionary is a document created by a buyer on receipt of merchandise and which describes each good and detail the quantity of each received. Credit notes. Credit notes is a document sent to the buyer to show the reduction in the amount owed by the buyer. There are cases where goods previously purchased may be returned by the buyer or customer. A document known as a credit note will be sent to the buyer. It is known as a credit note because the buyer's account will be credited to show the reduction in the amount he owes. Debit notes. Debit notes is a document sent to the supplier to show the reduction in the amount owed to the supplier. If a business returns goods to the supplier, a document known as a debit note will be sent to the supplier. It is known as a debit note since the supplier's account will be debit to show the reduction in the amount owed to the supplier.
This is example for goods received note, debit note, and the last one is credit note.
Hi, I'm Alya. Today, I'm going to talk about purchases journal. So, purchases journal is a record of all acquisitions made on credit during a period. In other words, it's a journal that keeps track of the order placed with the vendor credit or accounts payable as well as the current balance of each vendor. The source document of the purchases journal is the invoice received from supplier. A typical purchases journal has several columns to record the date, vendor account, invoice date, credit terms, accounts payable balance, and others account balance. The second thing that I want to talk about is sales journal. Sales journal is to record all of the company's sales on credit. Source document of sales journal is invoice sent to accounts receivable. The sales journal has 6 columns. A column for the transaction date, account name or customer name, invoice number, posting checkbox, accounts receivable amount, and cost of goods sold amount. Notice that there isn't a column for cash since all sales record in the sales journal are paid or credit. There isn't no need for a cash column.
Return inward refer to the goods returned to an organization by its customer. They are the goods that were sold, but usually because of unsatisfactory, it were returned back. They are also called sales return. In return inward, return inward in accounting refer to the goods returned by its business. In one case, it is a sales return. On the other, it is a purchase return. The transaction in both cases is reversed, and the concerned sale or purchase couldn't happen. Sales return reduce the total sales in the trading account. A subsidiary book called sales return book is made to record all the transactions.
This is example and format for return inward journal.
Outward refers to the good returned by an organization to its supplier. They are the goods which were purchased from the supplier. However, because of unsatisfactory, the organization give it back to the supplier. They are also called purchase return. Returns in accounting refer to the goods returned by a business to a supplier or a customer to a business. In one case, it is sales return, and in another case, it is a purchase return. The transaction in both cases is reversed, and the concerned sale or purchase does not happen. Purchase returns reduce total purchases of a company, and the deduction is shown in the trading account. A subsidiary book, namely purchase return book, is prepared to record all such entries.
This is example and format for return outwards journal.
Cash receipt journal, a special journal used to record money received. In a manual system, this will allow one entry to the cash account for the month or shorter periods instead of debiting the cash account for every receipt.
This is format for cash receipt journal.
Cash payment journal, the special journal that used to record all the payment that entity made by cash.
This is format for cash payment journal.
The last one is general journal. General journal is to record the following do not belong in any of the special journal, such as the purchases, sales, cash receipt, and cash payment journal. A typical general journal has at least 5 columns.
About today is the sales or account receivable ledger. The function of sales or account receivable ledger is a ledger for accounts receivable personal accounts. First, posting for credit sales. From the various accounts receivables, personal accounts in the sales journal, and the total sales are credited to sales account in the general ledger. Second, posting for returns inwards. Personal account in the return inwards journal, and the total returns are debited to returns inwards account in the general ledger from the various accounts receivables. And the last one, posting for payments received. From the various accounts receivables, personal accounts in the cash receipts journal, and the total amount received is debited to the account bank in the general ledger.
The purchase ledger is a sub-ledger which purchases are recorded. The purchase ledger is a part of accounting department database. It is not maintained by the purchasing department. The ledger is useful for segregating into one location of a record of the amount of a company spends with its supplier. The purchase ledger shows which purchases have been paid and which purchases remain outstanding. A typical transaction entered into the purchase ledger will record an account payable for at a later date by payment transaction that eliminates the account payable. Thus, there is likely to be an outstanding account payable balance in the ledger at any time. If the purchasing volume is relatively low, then there is no need for a purchase ledger. Instead, this information recorded directly within the general ledger. If you were to maintain a manual record of the purchase ledger, it could contain substantially more information than was just indicated. The data field in a manually prepared purchase ledger might include the following information for each transaction, which is purchase date, supplier code or name, supplier invoice number, purchase order number, identifying the code for the item purchased, amount paid, sales tax paid, and payment flag. The primary document recorded in the purchase ledger is the supplier invoice. Also, if suppliers credit back to the business for such time as return good or item damaged in transit, then you also record credit memos issued by the supplier in the purchase ledger. A credit memo may be issued for a volume discount. This credit may apply to a number of purchases in aggregate and so cannot be traced back to an individual purchase transaction. The information in the purchase ledger is aggregate periodically and posted to an account in the general ledger, which is known as a control account. The purchase ledger control account is used to keep from cluttering up the general ledger with a massive amount of information that is typically stored in the purchase ledger. Immediately after posting, the balance in the control account should match the balance in the purchase ledger. Since no detailed transactions are stored in the control account, anyone wanting to research purchase transaction will have to drill down from the control account to the purchase ledger to find them. Before closing the book and generating financial statement at the end of the accounting period, you must complete all the entries in the purchase ledger, close the ledger for the period, and post the totals from the purchase ledger to the general ledger.
General ledger. The general ledger represents the record-keeping system for a company's financial data with debit and credit account, records, validated by a trial balance. The general ledger provides a record of each financial transaction that takes place during the life of an operating. A general ledger holds account information that is needed to prepare the company's financial statement, and transaction data is segregated by type into accounts for asset, liabilities, honest equity, revenues, and expenses.